Unmesh Sharma to start the show with. He's from HDFC Securities. He's joining in to discuss some market fundamentals as well. Unmesh, good morning. Thanks a lot for joining in. What do you make of this market, Unmesh? How do you approach a market like this? Because you are up 3% one day, down 6% another, then up another 3% the next day. The retail investors made the most of this fall. But do you think now it's time to take a bit of a pause, or do you think that there's still more steam left ahead?
Yeah, good morning. I think if you had gone to sleep on Saturday and woken up today, you would have realized nothing's happened at all. I think it's interesting to see how all of this has played out. But in any case, I think the fact of the matter is that this volatility on a daily basis should reduce going forward. One key thing being whatever speculation there was about the formation of the government and all seems to have been put to rest now. Very clinical and efficient execution by the ruling party in that sense. Okay, so all from a market perspective, it's back to business as usual. I think, with the exception of a little bit of consumption and rural kind of focus, which is incrementally happening, we see absolutely no change in the way in which the government will approach either the public finances or the sectors on which they are focusing. So, it's very similar to what we would be saying last week, for example. On the large caps, there's a little bit more value, but that is also where the price discovery is happening because the FPIs have the ability to sell and leave the country. But in the small and mid caps, wherever earnings delivery is there, we continue to strongly believe that incremental flow should be invested in companies which are delivering earnings. So it will remain a stock because maybe the market's absolute level may go sideways for some time given how expensive it is. And as we roll forward to FY26, maybe after Diwali or so. But for the time being, I think in the small and mid cap space, the buoyancy should continue.
Okay, all right. Unmesh, hi, good to have you on the show. I remember, a conversation that we had earlier this year. I think it was around March or April. At that point in time, you weren't very optimistic on consumer staples because of obviously the concerns on growth and the fact that it was very anemic sort of, a low single digit kind of volumes that most of these companies were doing. Now the environment is different. Now there's talk of maybe some more populism, at least some more spending on the rural side. Some of these companies have had very good commentary in the fourth quarter result season as well. So what's your sense? And in terms of portfolio stance, is there any shift away from some of the economy-facing names to maybe consumer?
Okay, so look, on consumer, I think, that was our stance, absolutely right. And it's worked well, interestingly. So, quite happy to have that. That has changed a little bit, okay, for three reasons. One is that this is the type of market where if there is a story, even if the earnings are going to be delivered a year or two later, you would still want to kind of play that, it's that type of market. So with the change in the way in which the government went from a single party majority to coalition and some of the trends that we saw in the elections, we believe that incrementally for the next 5 years, the bottom of the pyramid consumption support will remain important. So from that perspective, rural becomes important. The second is something which we knew already, which is that we are expecting a very strong monsoon. And hence, if you put these two together, what we have done is that we have introduced some rural-facing names into our model portfolio. So it's not a shift really away from government capex, because that I think will continue to remain a big theme. But at the same point in time, taking some money away from cash and some of the things like InvITs and putting them into. We have increased our weight, even though we are overall underweight, but increased our weight on things like Maruti. We have added Britannia, and then, V Mart and so on and so forth. So to play the rural theme.
Okay, so just to follow up on that, you said you've increased the weight on Maruti and added stocks like Britannia and V Mart to the mix. V Mart, I guess, because they have, a great footprint
in tier 2,
tier 3.
There is rural tier 2, rural and tier 2. So it's not necessarily just completely that.
Fair enough. So V Mart makes sense. Just on Britannia, I mean, why, when you're talking top pedigree FMCG, why Britannia?
So, look, we do have Hindustan Lever. In fact, interestingly, Hindustan Lever, just because of valuations, actually, there was a big gap, which we have cut. So we have come closer to the index, but we still remain 100 pips underweight. But what we wanted is something which is in the index. So Britannia is in there, and we wanted to also have enough market cap to be able to play that. So incrementally, if you look on a relative value basis, that is the one that we've added in there. Yeah.
What about IT, Unmesh? That's the only sector that's not doing well today. And it was one of the top performers last week. The index was up 9%. There's also some supply coming in, considering a large promoter stake sale that you've seen in Emphasis today, likely stake sale as well. With macros not changing as much compared to FY24, do you still believe that the guidance that these companies have issued, say for the likes of Infosys and HCL Tech, do you think that is ambitious even with the conservative stance that they have taken?
Yeah, so look, IT, we are long-term believers. We believe that these are all phases when, there is always this confusion about discretionary spend and, shift. It could have been Y2K, it could have been digital, now it is the cloud, and now finally AI. But eventually, they will muddle through and kind of rise to the challenge. Overall, if you look at IT in our model portfolio, we have a 100 bip overweight, which is something that we've increased recently to slight underweight. Because of three reasons. One is that there was a relative underperformance and the valuation gap is there. And in the large caps, we believe that relative value is the game in town, given the fact that FPIs are also actively participating. But more importantly, what we do have is that on the IT, is that we have taken out of index and even out of classical IT bets. So what we do is that in our IT portfolio, for example, if you look at out of index, we have Emphasis in there. So amongst the classical names, so as to speak, and then, Tech M, we are overweight. But we also have things like MCX and TeamLease, which are like, kind of technology enabled, so as to speak. So that's how we are playing this. So services, we are a bit underweight in a sense, but if you look at the entire IT pack, we are overweight.
Okay, so let me end by asking you a very simple question, Unmesh. Given the new era that we are in, Modi 3.0, in your model portfolio, I'm not sure what the top weights are, but let's say what should be the top 5 stocks that everyone should have in this new era now?
Okay, I have to pick up my piece of paper to actually able to answer that. But I think we have, let not be too stock specific, but basically, if you look at large banks, we have the large banks in there. We still believe that in the large caps, we have relative value in there. We are playing financial inclusion and participation through things like insurance, and we've cut our weight on consumer discretionary. Finally, after being underweight for a long time, we've introduced things like Orient Electric and Crompton Consumer there. So that would be the third. And we continue to remain very positive on the domestic, infra-facing companies. So cement and building materials is another 100 pip overweight. And to round off, I think bottom up, we do like some of the pharma names. We have a new analyst, who's been quite positive on names like Dr. Reddy's and Cipla. So yeah, that's how we round up. These are the 5.
Just a clarification, you've cut weight on consumer discretionary, but you still have Orient Electric, Crompton Consumer. These are still stocks that you like?
No, cut weight as in we were deeply underweight. We've got very less underweight by adding these names in there. Okay. We were, through the year, we've been very negative on the consumer. We're kind of changing that now.
Well, Surabhi's questions, simple questions are not so simple after all. But Unmesh, thanks a lot for joining in and spending time this morning highlighting your sectoral and stock-specific preferences as well. That was Unmesh Sharma there of HDFC Securities. Time for a short break here on Trading Hour. Up next.
Thank you for watching CNBC TV 18 and do follow us on all our social media platforms for news, updates and more.